You have talked about how the central banks are sort of adjusting their approaches, with the Fed sort of backing off of the number of rate increases, the ECB moving from negative interest rates over to quantitative easing. Do you think that that may be what the Bank of Japan is thinking about doing?
Yeah, I think that is what they're thinking. You know, basically, if it's not going to work to pay the banks a negative rate when they're lending money to the central bank, why not try the opposite, which is if the banks are borrowing, they receive a negative rate. So, you know, look, we think there's
sort of a carrot and stick.
Exactly, because I think the markets, it's backfired a bit when you bring in these deposit rates down to below zero now, because that in some sense becomes a tax on the banks. They're not really passing it through to the end users. So it actually hurts the banks, it hurts risk sentiment, and it actually in some sense backfired. You saw, you know, markets when the Bank of Japan surprised and went negative on the deposit rate. The yen rallied, markets did not like that at all. So now the idea is, rather than try to take your rates down and try to weaken your currency versus everyone else, if they're all doing it, it doesn't really work. So try to make it easier for the banks and cost less for the banks to actually lend in the real economy.
Well, let's talk about what really works, because it's one thing to say to a bank, you ought to loan. It's another thing to get somebody to want to borrow the money. Talk about the transmission mechanism, which doesn't seem to be working very well.
Yeah, look, that is a challenge, and so that's going to be a challenge in Europe with effectively that policy that they're implementing with their TLTRO, and if the Bank of Japan goes through it, that's going to be a challenge. So I think, frankly, I think it does limit the effectiveness of these policies. But central bankers are saying, look, we need to get inflation to our 2% target. If anything, they're missing in a big way, and they're going in the wrong direction. So they need to do something. They need to ease policy. And this is a policy now that they think, at least at the margin, can get a borrower that maybe wouldn't have borrowed money before, and you make it a little bit more appealing, you get a little bit more demand. But no, is it going to be a sea change? I don't think so.
Jonathan, you run fixed income. I just want to know what it means for you. You see these kind of policies potentially in Japan. The stocks rally. What does it mean for credit?
Well, I think it's probably a good thing for credit, and I think you're seeing it. The sentiment in the market today is generally more favorable on the back of this news. If you go to an environment of less about currency war, less about trying to weaken your currency, but try to lessen the market impact, the volatility spikes that we've been seeing from some of these more aggressive policies, and frankly try to stimulate domestic demand, that actually should be good for overall growth. It should also be good in trying to avoid some of these surprises that have created, again, they've backfired in that they've created volatility, and volatility really isn't good for assets. So when you think about the credit markets, as long as we can have relatively benign growth outlook and a policy outlook that's actually going to be less susceptible to creating market shocks, that actually should be good for risk assets broadly, credit markets specifically.
Jonathan, I just wonder whether we really understand what these central banks are doing, more specifically looking at the ECB and that corporate debt programme. Buried at the bottom of the details they released just yesterday was this line: the Euro system will conduct appropriate credit risk and due diligence procedures on the purchasable universe on an ongoing basis. That tells me they're not a buyer to maturity. They could well be sellers at some point as well.
Yeah, I think we're a little bit skeptical about that. That's sort of a theory. I think, basically you look at the Fed, the ECB, the Bank of Japan, their balance sheets have gone up. They see this as a policy that's going to help, again, keep inflation from falling and will have a positive effect on the real economy. We're very skeptical that these assets, these balance sheets aren't only going to go up. And I think the downside is not so much that they're going to be selling assets, but that they may just reinvest. That's what you're seeing in the U.S. So the Fed has moved towards a tighter policy, obviously still very aggressive, but they're reinvesting those cash flows and not selling. The original plan was to sell. Now they're actually reinvesting, and they say they might let it wind down over time. I think that's probably the most negative outcome, is that they let it wind down rather than actually selling assets.
But, Jonathan, the point here is that the Fed was buying treasuries. They're not buying corporate credit. The ECB is going to buy corporate credit, and there's a different risk associated with that. My question is, do we really appreciate how effective these programs will be and how this will play out in the years to come?
Yeah, I think, look, all of these policies are, in some sense, experimental. So we're all going to be watching this. These are very aggressive policies. They are consistent with, in our view, a very ugly outlook in terms of growth and inflation. Central bankers have said, we're going to do what it takes to achieve our inflation goals, and they are being very aggressive. And frankly, it isn't clear what the end will be with all these. When you talk about stimulus, everybody loves stimulus, fiscal stimulus, monetary stimulus. They don't like the ending of stimulus because that actually seems like the opposite of stimulus. So it is unclear. They are going to be taking some risk in the corporate bond market. In Japan, you've actually seen them buying equities, and we think that may be part of the program as well. So there's some risk associated with this. There's some political risk associated with it as well. But we think in the near term, it is going to put a positive emphasis on risk markets and probably continue to dampen volatility.
Is the Bank of Japan learning a lot about communication here? When it spoke directly to the market, it went haywire. The yen strengthened. Now we have a report that the Japan Bank is thinking about doing something. Suddenly the yen weakens.
Yeah, I think it used to be the case that you wanted the bazooka. You wanted to actually shock the market, shock and awe. I think we've been at this for so long right now that shock and awe is not working. It's actually backfiring. So you actually want a little bit more transparency. You want to get the market prepared for policy change. And I think that is what they're seeing. And that's what they're doing, yeah.
Okay, Jonathan Beinner, Goldman Sachs.